Welcome and thank you for watching the Advisory Group's Pyramid of Success video series. As you begin your road towards financial success, we commend you for taking the time to invest in your knowledge base. We feel that the tips and techniques we will cover can help set the stage for you to work towards financial success. This is the second of our 4 video series designed to educate and empower you with understanding of key financial concepts you need to know. We highly recommend that you view all 4 videos. Let me first start with some introductions. My name is Chris Lee, and I am the Vice President of the Advisory Group. Also joining me in doing these series is Mr. Brent Beverly, the President of the Advisory Group, and Mr. Manny, a senior advisor with the Advisory Group. All of us are certified financial planner practitioners. Before we begin, it is important to review that there are 5 key areas of financial planning. They are protection planning, retirement planning, tax planning, investment planning, and estate planning. As comprehensive financial planning services firm, we try always to consider the impact of any recommendation we make on not just one, but of all areas for our clients. During this series of presentations, we will be covering the 4 areas you see highlighted on your screen: retirement planning, tax planning, as well as investment planning and estate planning. There are 4 separate videos that we have prepared, one for each of these subjects. Again, please be sure to watch all 4 videos. Let's first talk about the structure of your planning. This is what we refer to in our organization as the TAG pyramid. It represents a structure with different levels of priority to address and potentially seek. At the very bottom is the foundation. This includes the items you need to have in place and that we encourage you to satisfy. The estate documents such as the will and the healthcare directives. Your insurance policies to protect your loved ones and hard-earned assets and your home. Next up are your reserves. Your emergency funds that you have to keep on hand, likely at a bank, for immediate access should the unexpected and costly arise. Having this level of liquidity sacrifices potential growth, which again is why it can't be at too high of a level. Up next are your income-producing investment assets. These are considered lower risk than equity assets because of the fixed rate of return. These require your investment dollars, but have rates of return that aren't going to experience significant growth. Following this are growth and income-oriented investments. Now you're taking on more risk by investing in equities and exposing yourself to the ups and downs of the stock market. Here, you may be investing in companies that have the potential to grow at an above average rate, or those that pay dividends but aren't going to grow to experience significant growth. You then have growth investments. You're at a riskier level with your stock exposure here, made up of the growth investments we talked about in the previous level, and now potentially adding international stocks with room to grow. Finally, we have the exotic level. This is one where we will not provide much guidance. Investments such as collectibles, precious metals, lottery tickets, cryptocurrencies, they may be nice to own and cross your fingers on, but we simply will not structure them into a financial plan, or depend on them to produce results. Across all levels of the pyramid, we need to consider the impact of taxes. In this video, we're going to discuss taxes. Who likes to pay taxes? If you said, I do, no problem. You can always pay more, and the IRS and the state government will be very happy to take your money. If that is the case, you can stop here and go on to the next video. Our belief is that you should only pay your fair share of taxes. If you are part of the 99.9% of people who say, I would rather keep more of my money for myself, then understanding taxes can mean you get to keep more of your hard-earned wealth. Let's make an important point. Taxation is necessary. Our goal here is not to encourage tax avoidance. Our goal is to keep the most you can legally keep after paying your taxes. Here is another pyramid which you should know. On the screen is a chart of the 2024 federal tax brackets. Our structure is progressive, and you will fill up the lower brackets first, paying tax on your first dollars at 10% until your income exceeds that bracket. The next amount of income is taxed at the next bracket, 12%. And this process continues on as you climb up the pyramid. You only pay the higher tax on the portion of your income that actually goes into that higher tax bracket. Even if your income is large enough to be in the 35% bracket, the first $23,200 of a couple earned income is only taxed at 10%. If you have some income taxed at 35%, you will have portions of your income taxed at 32%, some at 24%, and so on, all the way down to some that is taxed at 10%. A key point is you are never worse off making more money. Just know that you'll owe a larger chunk on the last dollar you earn. The tax bracket which applies to the last dollar you earn is called your marginal tax bracket. Now, just for the record, there are other taxes that may be added to increase your marginal tax bracket, primarily state taxes. Here in California, if you were in the highest federal bracket of 37%, you would be paying a combined rate of over 50% in taxes. The reason this is so important is that we want to help you with your investments by lowering the taxation on your gains. Taxes play a part in two important calculations which you need to know how to do. In addition to taxes that you pay, there's an additional concern that you should have, which is inflation. The question you should be asking yourself is, how do taxes and inflation affect my rate of return? So the two calculations are your after-tax rate of return and your real rate of return. We're going to cover these now. You start with your top line rate of return. We're going to use round numbers for simplicity. Let's say we open a high yield savings account, for example, paying 1% interest. We know that seems really small, but these days that is higher than the interest you're probably going to earn at the bank. At 1%, that is literally 100 times what a traditional brick and mortar bank is likely to pay you. You still have to pay taxes on that 1%, as small as it is. So we're going to use the 24% bracket to take away from that 1% of earnings, leaving you with 0.76% as your after-tax rate of return. That is our first calculation. Just as a note, if you're a resident of California and you're in the 24% tax bracket, you get to pay additional tax to the state of California. So your after-tax rate of return is even less. But let's just say, stay with the federal taxation for now, to keep it simple. To use real dollars in our example, if you invest $10,000 into a savings account at 1%, you get $100 a year in interest, and that $100 results in a tax bill of $24, leaving you with $76 after all is said and done. Why is the after-tax rate of return calculation so important? What if you were able to make an investment at 0.5% completely tax-free for an account with the same risk and same liquidity features? For someone who says their goal is to avoid taxes, you might choose the tax-free investment. But when we compare, in this example, the after-tax rate of return, it is obvious that we get to keep more, even though we had to pay a portion away in taxes. Anytime you compare tax-free versus taxable, you want to work through this calculation. Finally, we take into account inflation and the inflation rate. Inflation is simply the fact that prices tend to go up over time. Think what homes used to cost 20 years ago and compare that to their prices today. This leads to a loss in purchasing power, or what we call inflation risk. For those funds sitting in the bank earning 0.01%, these are unlikely to have the same purchasing power with each month that passes. More so during high inflationary times. We recently saw inflation over 8%. But for this example, we're going to use a moderate 3.5% inflation rate. When we tax our return and then subtract off the tax and inflation, you get the real rate of return. So in the end, after factoring in taxes and inflation, the 1% rate of return actually netted you a minus 2.74% real rate of return. These days, with inflation being higher, that could actually even be lower. When you do this calculation using bank accounts and short-term bonds, usually your real rate of return is going to be negative. This is what we call going broke safely. This is the concern we have with having too much in cash. You have been a good citizen and paid your taxes, but after taxes and inflation, money in the bank typically loses spending power over time. So when we talk about risk as far as investing goes, risk surely takes different forms. Loss of spending power is one of those risks. There are three ways to save taxes on investments. You will hear us use the terms deduct, defer, distribute as your choices. If you're able to put money into a tax-deductible pension plan or IRA, those funds are calculated at the highest marginal tax rate that you pay. If you're in the 24% tax bracket, and you put $100 into a pension deferral plan, your income, it only changes by $76. The other 24 came from taxes that you no longer have to pay this year because your contributions are deducted from your income. Think of it as buying $100 worth of an investment with a $24 refund in the end. There's tremendous advantage to these tax-deductible contributions. Another advantage of pension plans or IRAs is that while they grow, you do not pay taxes on any growth. Dividends and interest that the underlying mutual funds or stocks pay don't subject you to an annual tax form. The term for this is tax deferral, and is another huge benefit of a tax-advantaged vehicle. So you never have to worry about receiving tax forms annually from these. The government makes these advantages possible not out of the goodness of their heart, but to encourage you to fund these retirement assets and become that much less reliant on the government in the future. The third way is to have the distributions come out tax-free. Distributions from a Roth IRA or a Roth 401k are tax-free. Principal where you have already paid tax typically comes out tax-free as well. The best you can do is to get 2 of these 3. If you're not careful, you may only get 1 out of the 3. For example, your typical bank account is not deductible, nor is it deferred, but when you use the money at the end, since you've already paid tax on the principal and earnings, you get your distribution tax-free. Your traditional IRA, you get 2 of the 3. You get the deduction when you put the money in, have tax deferral while it grows, but you get to pay tax when the money is withdrawn. Let's look at how this might work on different investment platforms. Remember, the best you can do is 2 out of the 3. With regular investments and bank accounts, you don't get to deduct the money when you put it into the account. You pay taxes each year as you recognize income, but since you have been paying your taxes all along, when you are ready to use the funds, you can distribute funds tax-free. When you do a traditional IRA or a typical 401k or other such retirement plans, your contributions are typically deductible when you put them into the account. Of course, there are restrictions on how much can be contributed tax deductible. The government wouldn't want to make it too easy for you to get the deduction, would they? As your funds in these accounts grow, they grow tax deferred. In other words, you don't need to pay tax on them each year. But when you want to use the money to get it, you have to pay your taxes. With Roth IRAs and Roth 401ks, the order is different. You pay your taxes on the funds before they are contributed, but then they grow tax-free. Even when you pull the funds out to spend them, it is still tax-free. As with all these programs, there are limitations on when you can actually pull out the funds without penalties, but we won't worry about that right now. As you can tell though, done properly, you again get 2 out of the 3 tax benefits of investing. We add an additional column here for non-qualified annuities. There's a lot of advertising going on regarding non-qualified annuities. They can have their uses. We use them when appropriate. When funds are contributed, they are not deductible, but they do grow tax deferred. When you withdraw funds, a portion is typically tax-free and a portion is taxable. There are numerous variations on this, too many to cover here. Beyond the underlying investments, another decision to make is what investment vehicle to use. Which is better? Each has certain advantages and disadvantages. Pension plans, such as 401ks or IRAs, are tax advantaged. In most instances, allowing you to deduct your contributions from your income and deferring taxes until withdrawn. These are huge advantages, which is why we look to cross these off the list before venturing out to invest in non-qualified or taxable investments. Sometimes we get calls from people asking us if we can help them open a brokerage account where they can buy tech stocks to their heart's content. If we get to know them and discover that they are not contributing to their 401k at all, or as much as they should be, we often steer them in that direction instead, because it may provide greater advantages, such as typically larger contribution amounts. As with any financial planning, you want to look at your own situation to see which plan provides you with the greater tax advantage. We also need to consider pension plan matching, which is a huge advantage. If your employer has a provision, for example, of matching 100% of your contribution up to the first 3% of your salary, that could be thousands of dollars that they will add to your 401k account. This is why we focus so much on pension plans being offered by your employer and encourage you to defer as much of your salary as possible within the maximum guidelines. The caveat, however, is that you have a very restricted control over the underlying investments. You're going to be presented with a diversified yet very limited list of investment options from which to choose. And as advisors, we're happy to make the most of them and provide you with our recommendations. But the universe there is still limited. Assuming you qualify for a deduction, a traditional IRA, if you don't have matching at work or you don't exceed the income thresholds to contribute to both your company plan and contribute to an IRA, this is a valuable tax advantage vehicle. An IRA also has the advantage of allowing you to control the investment. You can control the timing of the funds going in or transferring between investments. You can select the investment managers who best fit your needs, not just among a handful of select managers selected by your company. An advantage of a 401k is that it is funded by taking money out of your paycheck. But with an IRA, you take it out of your own funds. As we move to the third very broad vehicle, we look at what we refer to as non-qualified investments. Those without valuable tax advantage vehicles, giving you the greatest flexibility and control in the short term. Unfortunately, it can also hit you with the highest taxes. If your investment is generating dividends and interest throughout the year, as well as capital gains, you're going to receive a 1099 and pay for that income accordingly. So if you've exhausted the limits on the pension plan and the deductible IRA and still have excess cash flow, certainly discuss with an advisor ways to make those funds work for you. Non-qualified investments are also appropriate for your goals before retirement and to provide additional liquidity. Let's take a look at individual retirement accounts, or IRAs, closer. There are two main types, traditional or Roths. These are now becoming more common in 401ks as well, where you can choose between traditional and Roth 401k contributions. I will use the term IRAs here, but remember, the same thing applies to 401k plans. As we noted, a traditional IRA holds the advantage of allowing you to deduct any money contributed from your taxable income. So you avoid taxation on those funds until you pull them out of the plan and spend them. So down the line, when you take the money from your IRA to spend, you will add that to income for that year. A Roth IRA provides that you pay taxes on your contribution now, preventing any tax deductions. So you're taking after-tax dollars and funding the investment. And if you meet the criteria, you can withdraw them tax-free in the long run, no matter the amount of growth. Huge potential advantage. Since you can often do the same investments in either format, rates of return along the way do not differentiate which is better. Typically, you can do exactly the same investments in a traditional plan as you can in a Roth plan. To determine which is more appropriate for your situation, you need to look into the future and estimate the tax brackets you will be in when you plan to pull funds out of your pension or IRA and compare them to the tax brackets you are in today. Typically, if you're just starting in your working years, you'll be in higher tax brackets during your retirement years than you are right now. That would lead you to fund a Roth IRA instead of a traditional. As your working income goes up and you get into higher tax brackets, taking the deduction of a traditional IRA is likely better. If you're not sure or figure you are in a higher tax bracket, we recommend choosing taking the current deduction. A bird in the hand is worth two in the bush. As attractive and advantageous as IRAs sound, you're limited to how much you may fund. For each person in 2024, the maximum amount is $7,000, or $8,000 if you're age 50 or over. 401ks also have a limit to how much you can fund, which is currently $23,000 in 2024. These are subject to increase as determined by the government. I want to bring up our next speaker. Let me bring up Brent Beverly. Brent?